Iggy here, your favorite financial analyst reptile, coming at you with another video packed with insights on the wild world of investing. In this video, we'll be taking a deep dive into the recent bombshell news that's been sending shockwaves through the markets. Warren Buffett's Berkshire Hathaway dumping a massive chunk of its Apple stock. That's right. The Oracle of Omaha himself has sold over half of his stake in the tech giant in the first half of 2024. So, what's the deal? Is Apple losing its shine, or is there more to this story than meets the eye? Stick around and we'll unravel this mystery together. Let's dive deeper into the situation. Even after the significant sale, Apple remains Berkshire's largest holding by a substantial margin, indicating that Warren Buffett still has confidence in the company. He has publicly praised Apple, calling it an even better business than his other notable investments like American Express and Coca-Cola. However, his recent actions suggest a change in perspective, as selling 55.8% of his stake in Apple sends a strong message. So what could be behind this sudden shift? One possible reason is that Buffett believes Apple's valuation has become too high. The stock has experienced an impressive surge in recent years, and even the most exceptional companies can become overvalued. With Apple currently trading at around 30 times projected earnings, it's no longer an undervalued gem. This might suggest that Buffett is taking profits and adjusting his portfolio to maintain his value investing philosophy. Additionally, Berkshire may be diversifying its holdings or allocating funds to other opportunities, but the exact motivations behind this move are still speculative. Nonetheless, it's clear that Buffett's actions are worth paying attention to, given his reputation as a savvy investor. Another factor could be Buffett's desire to raise cash for future opportunities. With nearly $277 billion in the bank, Berkshire is sitting on a mountain of money just waiting to be deployed. Maybe the Oracle sees some juicy acquisition targets on the horizon and wants to be ready to pounce. There's also the possibility that Buffett is anticipating higher capital gains taxes in the future and wants to lock in some profits now. He hinted at this rationale during the recent Berkshire shareholder meeting, noting that selling a little Apple this year could benefit shareholders in the long run. But here's the thing, trying to predict Buffett's every move is a fool's errand. The man is a master at playing the long game, and he's not one to get caught up in short-term market noise. So while it's tempting to read too much into this Apple sale, it's important to keep things in perspective. That being said, there are some legitimate concerns about Apple's future growth prospects that could be contributing to Buffett's decision to sell off a significant portion of his stake. One major issue is the company's struggle with slowing iPhone sales, particularly in China, which has been a key market for Apple's growth. The decline in sales is a worrying sign, especially considering the iPhone accounts for the majority of Apple's revenue. Furthermore, Apple's regulatory issues are far from over, with the company facing antitrust lawsuits and probes on multiple fronts. These legal challenges could potentially hinder Apple's plans to expand its services business, which has been a key area of growth for the company in recent years. The services segment, including the App Store, Apple Music, and Apple TV Plus, has been a bright spot for Apple, but increased scrutiny from regulators could limit its potential. Additionally, Apple's high dependence on the Chinese market, both in terms of sales and manufacturing, also raises concerns about the company's vulnerability to trade tensions and geopolitical risks. All these factors combined may have led Buffett to reassess Apple's growth potential and adjust his investment strategy accordingly. On the flip side, Apple's new AI capabilities could be a game changer. The revamped Siri digital assistant and other AI-powered features could give consumers a compelling reason to upgrade their devices, potentially kickstarting a new wave of growth. And with a massive installed base of loyal users, Apple has a built-in advantage when it comes to rolling out new services and features. As of August 6, 2024, Apple's stock, AAPL, is trading at around $207.23, down 7.6% for the month. Despite the recent dip, many analysts remain bullish on Apple's prospects, Angelo Zeno of CFRA has set a new price target for Apple at $260, suggesting a potential upside of approximately 26.82% from its current price. This optimistic outlook comes with a reiteration of a buy rating on Apple. Looking ahead, analysts forecast sales growth of 8.1% and earnings per share of $6.59 for Apple in fiscal year 2024. While the introduction of Apple Intelligence could lead to a new wave of AI-enabled third-party apps and drive services revenue growth, the impact of these developments may unfold gradually over time. So where does that leave us? Is it too late to buy Apple stock, or is this a golden opportunity to scoop up shares on the cheap? As always, the answer depends on your individual investing goals and risk tolerance. If you're a long-term investor who believes in Apple's ability to innovate and maintain its dominance in the tech world, then this recent dip could be a chance to add to your position. The company's strong brand, ecosystem, and financial resources give it a formidable moat that's not easily breached. But if you're more of a short-term trader looking for quick gains, then the uncertainty surrounding Apple's near-term prospects might give you pause. With so many moving parts, from the iPhone upgrade cycle to regulatory challenges to the AI arms race, predicting the company's trajectory over the next few quarters is no easy feat. Current analyst forecasts for Apple stock are generally positive. According to TipRanks, the average price target for AAPL over the next 12 months is $239.54, representing a 9.90% upside from the current price. Out of 35 analysts offering 12-month price targets, 25 have a buy rating, 9 have a hold rating, and only 1 has a sell rating. The most bullish price target is $300, while the most bearish is $180. At the end of the day, the most important thing is to do your own research and make decisions based on your unique financial situation. Don't just blindly follow Buffett or any other investing guru. They're not infallible, and what works for them might not work for you. As for me, I'm keeping a close eye on Apple but not rushing to make any big moves just yet. The company has proven its resilience time and again, but it's also facing some stiff headwinds in the current environment. Like any good investor iguana, I'm staying nimble and ready to adapt as new information comes to light. So there you have it, folks. The lowdown on Buffett's big Apple sale and what it could mean for the future of this tech titan. Remember, investing is a marathon, not a sprint, and the best way to win the race is to stay focused on your long-term goals. If you found this video helpful, be sure to smash that like button and subscribe to the channel for more insights from yours truly. And don't forget to hit that notification bell so you never miss an update. Let me know in the comments what you think about Buffett's move and where you see Apple headed in the future. Until next time, stay savvy, stay diversified, and keep on investing like an iguana.